Ever wish you had like a cheat code for understanding those head-spinning financial products out there? Like you sense there's potential, but figuring out the nuts and bolts, well, it feels like trying to solve a Rubik's Cube blindfolded.
Ah, yeah, that's a feeling many share. The financial world, it can seem really complex, definitely full of jargon, but often these sophisticated products, they're actually built on some pretty solid underlying investment ideas.
Exactly. And today, we're cracking the code on something really interesting. We've got a set of materials here that dive into the diversified algorithmic income methodology, DAIM for short. Now, this isn't some, flash in the pan strategy. It's hypothetical track record. It goes back a full 64 years.
64 years. That's quite a history, even hypothetically. It gives us a lot of data to really dig into its performance characteristics.
And those characteristics really jump out, don't they? We're talking low volatility. Think of it as a smoother ride.
Yeah.
Returns that don't bounce around wildly.
Yeah.
Yeah, the standard deviation numbers are, 4.37% to 5.1%?
That's right. And just as importantly, the drawdowns, the dips, really minimal. The maximum drawdown over that whole period was only 7.43%.
Wow. Okay, so those numbers really suggest a strategy focused on, like, stability, right? Protecting capital.
Exactly. Aiming for steady performance rather than, say, explosive but maybe risky growth.
Precisely. And our sources explore how this consistent lower risk behavior could be, well, a potential game changer when it's used inside other things, like structured products and insurance wrappers. Imagine taking this reliable performer potentially and embedding it in different financial tools. You could create some compelling possibilities, maybe a safety net for your initial investment or the potential for extra income.
Yeah, and it's really important for you, the listener, to keep in mind that when we talk specific rates or numbers today, these are examples that are drawn straight from the source material just to illustrate what could be possible. The actual terms and conditions of any real product you might find out there, those are always set by the company offering it.
Absolute critical. Okay, so with that understanding, let's dive in. How could this DAIM portfolio power some of these structured products? Let's start with something maybe folks have heard of, principal protected notes, PPNs. Okay, let's unpack this. What's the core idea?
Right. So, at its heart, a principal protected note, or PPN, it aims to give you back your initial investment when the note matures, no matter what. And usually the way they do that is by combining a zero coupon bond. Think of that as locking in the return of your principal over time with a chance to participate in the potential gains of whatever the note is linked to. In this case, the DAIM portfolio.
Okay, so you get your initial money back. That's the principal protection part. And you also get a piece of any potential upside the DAIM strategy might generate. Our notes suggest this piece, the participation rate, could typically be around 80 to 100%.
That range makes a lot of sense, especially given the DAIM portfolio's low volatility. Because there's less perceived risk of big drops, the issuer, the company selling the note, might be more willing to share a bigger slice of the potential gains.
Okay. And the sweet spot for how long these PPNs might last, the term seems to be around 3 to 7 years. Why that time frame specifically?
Well, that time frame seems to align pretty well with the observed consistency of the DAIM strategy over time in the hypothetical data.
Yeah.
A shorter period might not really capture its potential benefits fully, but a much longer period, well, that introduces more uncertainty, even with a lower volatility strategy like this. And the study also mentioned something pretty striking, potential capacity. Up to $50 billion for these kinds of products linked to DAIM.
50 billion. Whoa, that's a huge number. A serious vote of confidence in its potential, yeah.
It certainly suggests that, based on their analysis.
Okay, so moving on from just keeping your principal safe, what about the idea of potentially earning more? Our source also explores enhanced yield notes. What's the key difference here compared to the PPNs?
Right, so with enhanced yield notes, the structure is a bit different. Instead of pure 100% principal protection, you might have, say, a fixed income component that provides a guaranteed minimum return. Our notes give an example, maybe a 2% to 4% annual coupon, something like that. And then, on top of that, you get the opportunity to participate in any returns the DAIM strategy achieves above a certain level.
Ah, okay.
Well,
So you get a little something guaranteed, like a baseline.
Yeah.
And then the potential for more if DAIM performs well enough. It's like having a safety net, but with a chance for a bonus, maybe.
Exactly. It's a trade-off. A bit less certainty on the principal, perhaps, but a guaranteed minimum income plus that upside potential. And the source highlights that DAIM's very high win ratio, 96.51% on a rolling 12-month basis in the study, as a key factor. It helps make the risk seem more manageable for this kind of structure.
Yeah, that win ratio is impressive. It suggests a strong likelihood of positive returns over shorter periods, which would make these enhanced yield structures seem, well, potentially more attractive.
Precisely.
Okay, now let's talk about something that can sound a bit intimidating. Barrier notes and reverse convertibles. The source gives the example of DAIM-linked barrier notes. How do these actually work for someone, trying to understand them?
Okay, so barrier notes introduce a specific price level, the barrier. If the underlying asset's value, which here is the DAIM portfolio's performance, if it touches or drops below this barrier during the note's life, that event can affect your final payout. It introduces a bit more risk. And there's a key distinction: American barriers versus European barriers.
American versus European barriers.
Okay.
Yeah.
An American barrier is typically monitored continuously or maybe monthly, so the barrier could be breached at any point. A European barrier, though, is usually only checked right at the very end of the note's term.
Got it. So American is like constant surveillance. European is just the final exam.
That's a good way to put it.
Our source suggests a pretty conservative trigger point, though. A knock-in level of 80% to 85% of the initial value. And they link this directly to DAIM's low maximum drawdown. That just makes sense, right? Because the portfolio doesn't historically drop that much. It's maybe less likely to hit that barrier.
Exactly. Given that historical max drawdown was only 7.43%, setting a barrier at 80% or 85% provides, well, a significant buffer based on that past hypothetical performance, and the potential reward for taking on this barrier risk. ARN suggests it could be an annual coupon, maybe in the range of 4% to 8%. Again, potentially higher returns tied to the strategy's perceived consistency.
Right, the trade-off for accepting that barrier condition.
Okay.
One more in this structured product category. Auto-callable securities, or in our case, DAIM auto-callable notes. These sound like they could be pretty interesting. What's the deal here?
Yeah, auto-callables. They have a feature that lets the issuer, the company, call the note back early. They'd return your principal, plus any coupon payments you've earned up to that point if certain conditions are met. And those conditions are usually tied to how well the underlying investment DAIM here is performing. The source mentions these performance checks, the observations, could happen, say, quarterly or semi-annually.
So it's like the note has an early exit button that the issuer can push if things were going well.
Essentially, yes.
Our source gives examples, like a call barrier maybe at 100% of the initial level, and a coupon barrier at 85%. What does that actually mean for me as an investor?
Okay, so the 100% call barrier means if, at one of those check-in dates, the DAIM portfolio's value is at or above its starting point. The note might get called back early. You get your investment back, possibly with a coupon payment for that period. Done deal. The coupon barrier, say at 85%, suggests that the DAIM value needs to stay above that level for you to receive your regular coupon payments. If it dips below, you might miss a payment for that period.
Ah, I see. And the source highlights something called a memory feature. That's particularly appealing here, especially with DAIM's consistency. What's so special about that?
The memory feature is quite neat. It means if you do miss a coupon payment because the condition wasn't met in one period, but then the condition is met in a later period, you might get paid all the previously missed coupons along with the current one.
Oh, wow. So you can catch up on missed payments.
Exactly. And considering DAIM's tendency for steady returns, that memory feature could be quite valuable. Less chance of permanently losing out on a coupon if there's a temporary dip below the barrier. The maximum potential term for these notes is suggested around 5 to 6 years in the material.
Fascinating stuff. Okay, so we've looked at how DAIM could potentially fit into various structured products. Now let's switch gears a bit. Let's explore how it might fit into insurance wrappers. Starting with fixed index annuities, or FIAs. Why does our source say the DAIM strategy aligns exceptionally well with FIAs? What's the connection?
Well, there are several key reasons. FIAs, fundamentally, are designed to offer protection for your initial investment, usually a 0% floor on losses, along with the potential for interest gains linked to an index's performance. Now, the DAIM strategy's low volatility and minimal historical losses make it a particularly good fit. Why? Because it reduces the risk for the insurance company offering the annuity, while still providing the potential for attractive returns for you, the person holding the annuity. It aims for a smoother ride for everyone involved.
Smoother ride. Okay. And our notes mention potential participation rates of 90% to 100% because of that low volatility. That sounds pretty good.
It is, potentially. Because the DAIM strategy, based on its hypothetical past, isn't prone to those huge, sudden swings. The insurer might be able to afford offering a higher percentage of the gains without taking on excessive risk themselves. The source also gives an example of a cap rate that's the maximum return you can earn in a year, maybe 8% to 12% annually. And it notes the strategy rarely exceeded this level in the past anyway.
Right. And a floor of 0% annually is mentioned, which, as you said, fits the basic FIA structure and DAIM's minimal loss history. That provides a nice safety net. The source also talks about how they might calculate the gains, like annual point-to-point comparing year start to year end, and maybe even monthly sums.
Exactly. Annual point-to-point is common and straightforward. Monthly sum crediting could also be attractive with DAIM's consistency, potentially capturing gains more smoothly. And from the insurer's side, there are other benefits mentioned. DAIM's tendency to sometimes move differently from the S&P 500, that negative correlation that can act as a natural hedge, helping balance their overall book of business. Plus, the low standard deviation, that low volatility, reduces their costs for the options they use to provide those participation rates and caps.
Ah, okay. So it's potentially a win-win. Good for the annuity holders' potential returns and peace of mind, and manageable risk for the insurance company.
That seems to be the argument presented in the source material, yes.
Okay, what about variable annuities, VAs? How could the DAIM portfolio fit in there?
So in a variable annuity, you typically choose from a menu of different investment options, like mutual funds, within the annuity contract itself. The DAIM strategy could be offered as one of those investment options, likely positioned as a conservative to moderate allocation choice, given its risk profile. Its low volatility could be beneficial in supporting some of the enhanced death benefits that certain VAs offer, makes those guarantees potentially less costly for the insurer, and its consistent return profile could also provide a more stable base for things like guaranteed minimum withdrawal benefits or GMWBs.
So it could act as kind of a reliable anchor, maybe?
Yes.
A less bumpy part within a broader mix of investments inside the VA?
That's a good way to think about it. Our notes suggest that allocating maybe 20% to 40% of your overall VA portfolio to an option like DAIM could be a reasonable approach, depending on individual circumstances, of course.
Okay. Now, registered index-linked annuities, RILAs, sometimes called buffer annuities. The source specifically mentions these. What's the DAIM connection here?
Right, or ILAs, or buffer annuities. They offer a degree of protection against losses, but not usually a full 0% floor like FIAs. Instead, they have a buffer. For example, the first 10% or 15% of any market decline might be absorbed by the insurance company. You only start experiencing losses after that buffer amount is exceeded.
So some protection, but not total protection.
Exactly. And in exchange for that buffer, your potential gains are typically limited by a cap, similar to an FIA. Now, because the DAIM portfolio itself has lower volatility, our source suggests we might see potentially higher cap rates with RILAs linked to it, maybe in the 12% to 18% range, even while still offering those downside buffers of, say, 10% to 15%.
Interesting. So the lower risk of the underlying strategy might allow for more upside potential with the buffer.
That's the idea presented. The source also mentions potential floors, the maximum loss you could face in a year, perhaps around minus 10% to minus 15%, aligning with the buffer, and it notes a possible annual management fee structure, maybe 0.50% to 1.00%.
So it really does keep coming back to that core characteristic, the consistent, less volatile performance based on the historical data.
Precisely. If we step back and look at the big picture here, the fundamental appeal, the reason why using the DAIM portfolio across all these different products is being explored in these sources, it really boils down to that long hypothetical track record showing low volatility, those minimal drawdowns, and importantly, its tendency to perform somewhat independently of the stock market's ups and downs. That non-correlation piece is key for diversification.
Right. It's that potential for a smoother, maybe more predictable ride that makes it so interesting for creating products. Products aiming to offer things people really value, like keeping their initial investment safe, maybe generating it more income, and providing some defense against those scary market downturns.
And our source also briefly touches on some important practical things to keep in mind, implementation details. For instance, if these were offered as securities, like the notes, they'd likely need SEC registration. Insurance products like annuities need state approvals. Standard stuff, but important. The strategy itself, it's implemented using futures contracts, it involves monthly rebalancing, and it generally requires relatively low amounts of margin, which could make it more cost-effective to manage within these products.
Good points. And it looks like the target audience, the potential market for these DAIM-linked products, is pretty wide, isn't it? Our notes mention everything from high net worth individuals and family offices looking for diversification, all the way to people maybe nearing retirement or just, affluent investors who are maybe a bit more conservative but still want some growth potential?
Yes, the characteristics described, that stability, the non-correlation, could potentially appeal to investors across different risk tolerance levels and with various financial goals. The source material really highlights the potential competitive advantages stemming from these characteristics. It suggests companies could use DAIM to create perhaps more compelling and attractive options compared to products linked to more volatile indices.
Okay, so to wrap things up then, this deep dive into our sources really suggests that the DAME portfolio, with its long hypothetical history and its lower risk profile,
Hmm.
it can be a really interesting foundation, a building block for a whole variety of structured products and insurance wrappers. It offers the potential, based on this analysis, to create financial tools that aim for principal protection, maybe enhance returns, manage downside risk, in a way that could be genuinely appealing to a broad spectrum of investors. The key takeaway seems to be that potential for maybe peace of mind combined with steady gain opportunities.
Absolutely. But it is so vital to remember our discussion today, it's been an exploration of potential applications based purely on the information in our source material, the
Hmm.
actual terms, the availability, and crucially, whether any specific product is suitable for your individual financial situation. That always depends entirely on the offering company and your own circumstances and goals. Always do your homework.
Couldn't agree more. Essential reminder. It really gets you thinking, though, doesn't it? Given the Dame portfolio's unique set of characteristics described here, what other innovative financial products or investment strategies might be possible down the road? It's definitely worth considering how these kinds of structured solutions and insurance wrappers, maybe powered by strategies like DAME, could potentially fit into a well-thought-out, diversified investment portfolio for you, something to mull over.